Good morning. It's Monday, July 20th, and here's the mortgage market setup in plain English. Treasuries are backing up, MBS are softer, and the public snapshot says the 10-year is at about 4.58%, while UMBS 5.5 coupons are off 13/30 seconds at 99.73. The latest published daily 30-year fixed rate is 6.63%, and crude is still elevated, with WTI near $82 and Brent near $88. This is not a complacent market. It's one where rate sheets can get worse fast if the bond sell-off sticks. From a Chrisman-style MBS angle, the important thing isn't just that treasuries are higher, it's that mortgages are not getting any help from the basis. The clean public proxy puts the mortgage to 10-year spread at roughly 205 basis points today. On a matched official basis, Freddie's weekly 30-year rate at 6.55% versus the official 10-year close at 4.57% on July 16th is still about 198 basis points. Translation, even when treasuries calm down, mortgage rates still have cushion to stay stubborn. Here's the MBS desk takeaway. Publicly visible 5.5 coupons are weaker this morning, and MBS commentary says the sector is moderately weaker overall. That usually means lenders who were conservative on the morning sheet may hold, but lenders leaning aggressive are open to worse reprices if the weakness extends. If you get a decent window today, especially on a live purchase, think execution, not prediction. What's driving all of this? Two cross currents. Last week's inflation data cooled. CPI was down 0.4% month over month on a seasonally adjusted basis in June, and PPI fell 0.3%. But the market is still carrying an oil and geopolitics premium because the Middle East situation keeps threatening the inflation outlook through energy. If oil stays bid, the bond market will keep respecting that risk even after friendlier inflation prints. The Fed is also part of the story, even though there's not much Fed speaking left to trade. The June FOMC minutes said inflation risks were still tilted to the upside and specifically pointed to higher energy and input costs from the Middle East conflict. The committee removed prior easing bias language, and the next meeting is July 28th and 29th. We're already in the Fed blackout window, so this week the market will lean more on data, oil, and treasury supply than on speeches.
What matters this week? Today's LEI already came in down 0.2% for June. Midweek, treasury supply matters. A 20-year bond auction. Wednesday, 10-year tips Thursday. On Friday, you get flash US PMI at 9:45 Eastern and new home sales at 10 Eastern. None of that is CPI or payrolls, but in a market this headline sensitive, it is enough to move pricing at the margin.
For loan officers, the playbook is simple. 1. Don't sell hope, sell structure. 2. Watch your rate sheets more than your social feed. 3. If pricing improves, be decisive on locks. 4. Temporary buydowns, FHA, VA, and ARM conversations matter more in a 6.5% world. And 5, this is a realtor conversion market. Buyers are payment sensitive, not gone. The loan officer who can explain the market and structure the payment is the one who wins.
Bottom line, the bond market is telling you to stay humble, stay alert, and stay executable. Treasuries are heavy, MBS are not getting much cover, and oil is keeping inflation risk alive. If you want to win this week, move quickly when the window opens and stay disciplined when it doesn't.